Good morning, everyone. This is Teddy Kekstadt from Forex Trading Unlocked, and we're here with a Forex market breakdown for you, sponsored by Nadex. Let's just get to our first order of business. We're going to take a look at our disclaimers from Forex Trading Unlocked and also the Nadex. And this is just to remind you that this webinar is for illustrative purposes only. With that, let's now move on to our first order of business. Let's look at the economic calendar. So for the next 3 days, we have a lot of central bank people talking. So for the US Fed, we have Powell speaking today. We also have the FOMC minutes that will be released later today. That could possibly have a little shakeup in the US dollar related crosses as well as the US stock market. And then on Thursday, we have, for the euro, we have monetary policy. Now, this is something that we're going to have to pay attention to if you are a euro currency cross trader. And then for the US dollar, we have CPI, which is always one of our big fundamental economic indicators. And since the consumer price index is definitely one of the top indexes to take a look at, I'm sure there's going to be lots of people eyeing that, and especially the Fed, which is obviously speaking today, and then we have other central banks that are speaking as well. So then we also have, for the British pound tomorrow, the Bank of England's Governor Carney is having a speech. And then on Friday we have, for the euro, we have the harmonized index of consumer prices. That's a German number. And then we have also for the ECB, their chairman Draghi, President Draghi is speaking. So we have a lot of central bank rhetoric that will be flying around over the next 3 days, as well as one major US economic indicator. So let's go on to look at our first chart. So the euro US dollar, time for a correction or a change in trend? And the thing is the US dollar ready for a change in trend? The dollar index was a little bit strong, was showing signs of strength to begin the week. But overall, your major currency crosses are starting to show maybe it's time for a little pause in the dollar rally. So let's see what's going on here. So we have a couple of colored lines here. This green pivot line right here is going to be one of your major pivots to key off of for probably the next 2 to 3 weeks. The reason being is we have to remember that Brexit is coming into play soon. So we have this, excuse me, for the upside, we have this $1.1115 as an upside breakout level. That was the last major lower swing move high that is setting the trend lower for the euro US dollar that has remained in for basically the past 4 months. So now the euro US dollar has been in a range trade for pretty much a year, but over the last 4 months it's been trending lower from $1.14 down to where it bottomed down here near $1.0876. Now when the euro US dollar set this excuse me, lower move low, it ended with a piercing line formation, which is a short-term buy signal or a change in trend indicator, which right now has been holding up. And if the turning signal actually runs its full course, then we should see the euro US dollar breach this downward sloping resistance line, which would take us out of the downward sloping channel that the market has been trending in, and then probably have the bulls bucking up against this 110.30 area, which we mentioned at the beginning of this chart. This is key support and resistance. It's a big pivot here. The market for the euro US dollar, historically, once it gets down into this 109.5 to 108.5 area, it seems that no matter what, you cannot keep this market down below here. Is it psychological? I couldn't even begin to tell you why, and because there's times when it seems like this the bears just want to take this euro US dollar all the way down to parity, but it just doesn't happen. So does that mean that this bearish trend is going to end because of that? No, not at all, but it just is something that you have to keep in mind as far as key support. So that's why we have this, the two yellow lines here as breakout levels. One is the upside and then one is the downside below this piercing line, which has us in a range trade between those two areas. Now that's actually not a lot of room there. It's only a little over $2 there, so it's not like there's a lot of room for trading, for swing trading here. And if you look at the ranges too, the last few days, especially, you're looking at ranges where you have a 50 to 60 pip range, which doesn't really give you much room for trading action, really. So what we are kind of heading into, I believe, is a range-bound market to possibly higher. Is this piercing line the low? Well, right now it currently is the lower move low. And if you look at how the market has been channeling, it doesn't make severe stretches when it takes out the current lows that are in place. So this current low here, it took the market a little bit lower, and then it starts to gravitate back towards the upper part of the channel, which it seems to have been doing for the past 4 months. So historically being, the trend being your friend, we have lower move highs and lower move lows that definitely have us set up for continuing of the trend on a fundamental basis. But technically right now, since we have the pause and we have the market eyeing this little downward sloping resistance, I think you're probably going to see a challenge of at least this blue line sometime over the next couple days. That doesn't necessarily mean that it's going to rally. Just by attrition over the next few sessions, the markets, even if it's just the high of today, that's going to come into this little line. So right now, if you're a bull, I think that you're going to have a lot of patience just because this market hasn't really had very many big moves over the course of the last 4 months. And then we've had a lot of rate, no matter what, even if you look back just a few weeks, anytime we've had a big rally, it tends to have a severe break to neutralize it and then come back. So there's a lot of range trade, choppy trading going on. You can even look over the last 4 sessions. If you were looking to play breakouts upside or downside, whether you were outright trading or if you're using options, you were probably getting chopped up. If you're looking to trade the containment for this range, however, which is summertime's over, it's the fall, it's October of all things, you would think we would have more volatility. So what do we look at here? So right now, let's just look at the technicals, and since the fundamentals aren't driving this market anywhere. And so with this technical buy signal we have here, we have already where the market has rallied up and has set a lower move high. And then we have this here where we set a higher move low. This is on a very small intraday daily scale, but it is starting to set a signal that we're probably going to challenge and make higher move highs here. Now, if it does that, then we're looking to have a challenge of this $1.1030 area into this target range. This would be probably where you're going to see, if this is just a corrective move higher, that the bulls are going to run out of gas. And this is where the bears are going to try and pounce again and get this market below $1.1030. Now remember, right here, this is October 31st. This is where we're coming into. That's the Brexit. Now we have no deal going on right now, and we know that on the Euro, the EU's side of the Brexit deal is they don't want Brexit to happen. They don't want the UK to leave, and they want to keep everything as it is. And they're definitely, obviously, the way it seems, going to still stay on that hard point. And I think October 31st is going to come and go. And well, hopefully sometime between now and October 31st of 2020, maybe they'll come up with either they're going to do it or not do it, because it's almost like Brexit is the never-ending story now. So with that being said, let's take a look at this for your downside. Now your downside here, this would be any failure of 108.76, which then takes the bulls definitely off the table, and the bears are definitely going to be salivating, as the euro US dollar would be pressing multi-month lows, as well as pressing the trend, actually setting a true trend, which it hasn't had in over a year. Now here's the one thing we want to look at. Is the euro weak, or is it because of dollar strength that's driving this move? And if you look at this market, the euro US dollar is one of the biggest crosses versus the dollar. So this short-term buy signal, let's say that the bulls take the market up into this target range up here, and we start to hold this area, then we have a good chance at maybe seeing, especially if the other currencies like the pound, the yen, and the Swiss start to turn against the dollar, then maybe we have a correction in the dollar that's going on, and not necessarily dollar or euro strength that's coming into the market. And that being said, that would help to alleviate the pressures of the euro US dollar bear and start to not necessarily make it a bull, but if we have dollar weakness, give the euro some strength, which would then have them taking a challenge, not only heading into our target area, but then having the market challenge is 111.15. That then just has it going back into this wide range area where we could possibly easily shoot back up to the 112 half, 113 even over the course of the next month and a half or so. That would not necessarily make the euro US dollar a bull. That would probably mean that US dollar strength is waning. And if you look at the dollar index, as strong as it is, it's also showing indications of a potential turn. So now just remember these levels, and especially for range traders, keep it tight below this 110.30. And I think, like I said, over the next few sessions, as we head in towards the end of the week, and even in towards Brexit, you're most likely going to see a containment with trading above the 108.76 up to into this target range. So that making it a very good environment for options and range traders. If you're outright trader, I think it's going to be a very tough bull where you're going to have to, like for instance, if you're in it now, you're just going to sit on it and have to just raise your protection as the market goes. I wouldn't look for any major rally to occur. And also contrary also for the bears, I think this market is pretty much beaten down as about as much as it can be, unless there's some major really big news in the EU where, for instance, there would be a change in their ECB's outlook as far as the targets for the economy, as well as also for interest rates, which I think right now they're beyond transparent, where they are keeping rates low to lower, as well as doing every type of QE thing that they can do, and basically trying to head off any type of recessionary environment. So with that, let's go on to the next chart, the British pound. And since we've talked about Brexit, you can see there's a Brexit deadline there. Makes it a little clearer about how close we are coming to it. It's kind of weird that we're already, it's October, the first week in October is chipped away. We're into the second week, which means, yeah, we're only 2.5 weeks away from this deadline. Now, we've got lots of up and down arrows here, so let's see what makes sense here. Obviously, excuse me, the sideways one targets the date. So we have the British pound that had set a low at the beginning of September and had quite a nice rally up into this 125.85 area. And this is where we see this downward sloping resistance line from the trend lower that it bounced off of. And then it set a correction here. And this last slide lower is bearish move that we've had over the past 2.5 weeks has been since Parliament was restored. Now, does that mean that that Boris Johnson has lost his control over the direction of the UK and heading towards Brexit and making it happen? No, not at all. All it just means is that from this rally where he had gained momentum after he had been in office for a month and started to set a tone that, that strength had come in, but it's not necessarily overbearing. It just is a tug of war, I think, between the new prime minister and then his failure to keep Parliament suspended. Now, does that mean that Parliament being back in action is going to keep everything from happening? No, not necessarily. I think that no matter what, Boris Johnson is trying to get the Brexit to happen over the next 2.5 weeks. So now, are we going to hear anything today? Or is they going to say all of a sudden tomorrow, say that Brexit's going to happen, we're on track? Probably not. I would say that unlike a Hollywood ending where they're trying to build suspense, I just think we're dealing with governments that, especially since they're acting like children, they're going to wait until the very, very, very last minute to either come to the Brexit table and make it happen, or they're going to push out a deadline and then we'll just have more of the same. So going into it, this is kind of like, unlike when we have the winding of the coil for markets when we're heading into a central bank meeting, this is a little bit bigger than a central bank meeting because central banks are involved, but now it's actually also questions of sovereignty and nations that are involved. So it is a big deadline, and the fact that dollar weakness is starting to rear its head, that would hopefully give a lift to the pound, because as you can see, if you look at this chart, even though it's in a short-term correction lower, the market's been trading higher. It looks like it's bottomed out, at least over the short run. I mean, it hasn't been trending lower now technically for 2 months. It's been more of a sideways trade. So that's where we have this. We're going to key off of these higher move highs and lower move lows as our directional targets. So right now, as long as the market is above $1.2076, it's not bullish, but it's fairly strong. It's stable. Below $1.2384 here, we have the market under pressure, which it is right now for this correction. And off of this high, we had set a higher move low, a lower move high, and then a lower move low. So short run, this trend is definitely secure on a fundamental technical outlook, if you will. But if you look at it from a longer term perspective, we have the low that was set, excuse me, in the beginning of September. We had this lower move high, which was this recent high, and this could be a higher move low that's forming. So what does that mean? So we have the intermediate and short term directions that are starting to show divergence. Usually when that happens, it's not necessarily you're going to see a turn in the market, but you're going to most likely see a little bit of sideways action. A sideways action going into the Brexit deadline over the next 2.5 weeks sounds very practical from a trading standpoint. So right now I would key off of your highs and lows for breakouts, for swing trades, and with inside the next 2.5 weeks, I would look for a containment between these two areas of this last current move high at $1.2415 down to $1.2384. I think this is your resistance band for any upside trading. And then as well as support, I think that anything above $1.2076 is you're probably going to see spikes where you have dips to buy. And if you look at this also, look at how it's been making these lows. Made a low, spikes up very high very quickly. Even here, it made a low yesterday, and today's trading, even though we didn't press the lows, we went all the way almost up to the highs, came all the way back, we're only slightly higher. So this is starting to show a lot of indecision that is going on, or where you have moments where news comes out and it is definitely factored into the trading mindset. But I think as a whole, everyone's really starting to look at it, is the Brexit going to happen or is it not going to happen? To count down, does it have the British pound bulls trying to build a base? Well, I think the base has already been built. It's just a question of can they maintain it, or is there anything that could propel a bearish sell-off to occur over the next couple weeks. So what would that happen? What would make something like that happen? Well, now we have the pound US dollar, remember, that is influenced by interest rate decisions. So we know that those variables are already factored in. So as far as the US dollar, if it is starting to get weak, like it's starting to show signals, like we said, from the dollar index, and it looks like the euro is starting to try and at least get a correction going, a more sustained correction. Well, that gives lift to the pound, because if there's dollar weakness, doesn't necessarily mean pound strength, but it usually would mean that we get a little lift. So the bulls probably have a little bit more of an edge right now, so it's probably more of a buy dip scenario going on for the British pound US dollar versus being necessarily totally bullish. But as far as being bearish, there's too many factors that don't seem to keep pressing it. The interest rate component we know is already out there. And then as far as dollar weakness, if it starts to really rear its head in other currency crosses, like it seems to be in the euro, and we're going to take a look at the Swiss and the yen also to see if we can get confirmation of this. So definitely as we head into the Brexit deadline, I would say between these two up and down arrows, this has got kind of a wide range here. But remember that the pound, unlike the euro, like remember we mentioned in the first slide of charts where the euro has been contained to a 50-60 pip range, the British pound is a little bit different. It has typically a 50-60 pip range no matter what in any given day, and when it starts to move, boy does it move. It's usually a freight train, like you can see obviously on this chart, when it's had severe breaks or even rallies, but even moves. Look at the ranges, like today's range, we've had a dollar range with next to no activity, and it's unchanged. This market has volatility, it has movement. So for range traders and options traders, I think you have lots of opportunities to jump in on these little mini swings that are occurring on a daily basis, and they're also somewhat contained. So I think that your risk-reward ratios could probably be held in check, and it'll give you probably a little bit more of an edge on that, because your risk is probably not as severe of being either a bear or a bull over the next week and a half to 2 weeks. But remember to watch your other currency crosses and the dollar index. Any sell-off in the dollar index will most likely have the British pound US dollar challenging this upper resistance band at about 23.8487. And if we take out this high above here, this is a buy signal that will have this market probably challenging this downward sloping trend channel here. Again, major resistance, but trading back above here would mean that this British pound US dollar for sure is in a pretty solid bottoming to bullish trend that is kind of locked in then for the fall going into the rest of the fourth quarter. So very interesting stuff coming ahead on these two markets, and especially being the two major components of currencies versus the dollar. Any type of bullish momentum that starts to rear its head, especially in the pound and the euro, is going to give credence to a US dollar sell-off and a bearish turn. And the US dollar could use a correction right now. If the US dollar takes a turn for even a couple months, most likely it wouldn't be that severe, and it's just overdue for a correction. So not that it has to happen now, but it's the likelihood of it occurring is increasing day by day, and especially as we get through some of these major political, economic turning points such as Brexit. I mean, after all, God forbid Brexit actually comes to some sort of a deal on October 31st, which I highly doubt is going to happen, but should it occur, that where we don't have to talk about it so much anymore, well, then we can look at other fundamental factors and other economic factors that'll help give us some more transparency and clarity. So with that being said, once again, key off of this little resistance band at $123.87, $124.15. And otherwise, right now, we're sideways to lower, looking for a test of this $120.76 area. So let's move on to our next chart. So we're still in the Eurozone. We looked at the Euro US dollar and we looked at the pound US dollar. Now we have the US dollar Swiss, which as a whole has been in a rally for the last couple months, and it's been doing the parity dance. Last week it poked its head above parity 4 times and wasn't able to close above it once. Now it did set a higher move high. However, we seem to have some potential turning going on with the US dollar Swiss. Now remember, the US dollar and the Swiss are the two flight to quality currencies in the globe. So US dollar strength here is just like it's showing the dollar index has been there, but the dollar index looks kind of a little bit like the US dollar Swiss does as of late. So I don't know if that is a true correlation and they're just kind of doing the same dance, but if they are kind of in the same line, then that goes with our little theory that maybe we're starting to see some weakness creep into the US dollar, which would gain strength for other currencies. So right now, even though we have made a higher move high, and right now it seems that the market is making a higher move low as it rides this upward sloping channel, I think that even by attrition, we can take this channel out, which would put us into this target zone here. So we don't necessarily have to break down. We can just keep going sideways for a couple days, which remember, the Swiss, it's also part of the EU and in that trading zone. So what goes on between the UK and the rest of the EU is definitely significant in the US dollar, or excuse me, the Swiss currency relationship to those currencies, as well as to its relationship to the dollar. So that being said, right now we have higher move highs and higher move lows. The trend is higher. It is a bull. So for directional traders, I would say that if you're going to ride the trend, you key off of this low from yesterday, or even more so this low that was set a week ago. This is right in the middle of our target zone here. And I think that this 98.97 down to 98.49, this is really your support base. If the US dollar is going to remain strong, and if the US dollar Swiss bull is going to remain strong and keep trying to make a challenge of parity, then this would be the extent of any type of slide, because a failure from 98.49 means that this higher move low would be taken out. That being said, that means we would be making lower move lows, which is a bearish indication that the US dollar is under pressure, and that Swiss strength is also in the market. And well, then instead of our target zone here, which we can just come into by attrition from sideways trading, we would most likely be targeting this area down here to probably the 97.5 to 97 even. So what would that mean? That would help to reinforce our US dollar weakness, which would also be our guide for the Euro US dollar, giving them a lift, and also giving the pound US dollar a lift as well. Once again, would that mean that this is because of Swiss strength? In this situation, yes. With the euro and the pound, any type of action like that would be more because of dollar weakness. So if we have a slide in the US dollar Swiss that occurs, dollar weakness is definitely there, obviously, because of the break, but Swiss strength is there because the Swiss is strong versus many of the other currencies, especially the pound and the euro. So that means that if, like I said, we have this little tug of war, and this we don't have divergence in the other currencies, like we mentioned before, we may start to see divergence in the Swiss with the dollar, and that usually occurs right before you have a US dollar sell-off or rally. When you have those kinds of things, right now we would be looking for the correction, which would fit in with our little theory that we could take out this little target zone here, this initial one, and fall below 98 and head into this area. Now you got to remember, we did the parity dance last week. Somehow, some way, just like the euro US dollar can't seem to get below 108.5, the US dollar Swiss has had a lot of trouble with parity over the course of, well, just this year. Every time it goes there, it seems to maybe get a spike up to 101 even, and then it falls right back down. Once again, this has happened again, and we're heading into the Brexit target and things like that. So it's almost like we have kind of like the perfect storm brewing for this scenario. It's a little more transparent. The nice thing about the Swiss is that we pretty much know what's going on with them, with their central bank, with their economy and everything. Everything is chugging along. There's no real problems there. It's the EU, which is grappling with trying to keep the UK from regaining sovereignty, and then the UK that's in complete turmoil with leadership because of their indecision on whether half the country wants to break away and half the country doesn't want to break away, and also the trade implications that it will have moving forward. So once again, let's key off the US dollar Swiss trading to help us with the euro and the pound for direction. And one thing to remember is that for most of the year, while the US dollar has been rallying and the other currency crosses have been breaking, the US dollar Swiss has been in a divergent area. So especially when the dollar was strong, the US dollar Swiss was breaking. So this right now could be the end of what was a corrective move higher that started over the summertime, and now once again, especially being rejected at parity, what better of a place to get rejected than parity before you start to have a major leg down? Now, am I calling for a major shift in the trend and a major bear trend in the US dollar? No, but for a bearish sell-off and maybe the beginnings of a US dollar Swiss bear trend that could last for upwards of 6 months, absolutely we could be coming on the cusp of that. So whereas we were looking more for range traders in the last two currencies with opportunities, I think right now you have to be a very, very cautious bull, and especially if you are flirting with parity. So if you're a bull, you know, look for the dips to buy before you're making a run for parity. For bears, I think that you can aggressively be targeting lower levels, anything below parity, and especially any failure of this upward sloping blue line and down below 98, 97, this market will be on edge, most likely targeting 98.49 before it heads into this lower correction. So So real quick, let's look at the other side of the world than the European sector. And here, let's look at the US dollar yen. So the US dollar yen has a bearish target zone set, which would go and coincide with our US dollar Swiss starting to make a turn. Now, the US dollar yen, even though the dollar has been strong, this market's been trending lower for quite some time. So we know that the interest rate component is off the table. It's not dictating anything. So since we talked about the potential for a correction being led by the Swiss and the yen, let's look at what happened here. So recently we have this yellow line up here at 108.501. We had this high, which is set with this downward sloping resistance, and then we had a higher move low, and then we had this high that was set a little over a week ago, and it failed to make a higher move high. And then it was followed by a lower move low. That's why we have this little pivot point at 106.478. This is our line in the sand for direction. Any failure here obviously would mean lower move lows and has us heading towards this bearish target zone. Right now, this downward sloping resistance line is coming into here. I think this is going to contain any rally, and especially as long as the market does not get above 108.501, I think you're going to be in a sell rally and bearish forecast, which means that the US dollar is definitely weak against the yen. And this is a case that I think that you have yen strength that is dictating this move. It's not dollar weakness. And it also means that as far as what's going on with the relationship geopolitically, that whatever the U.S. is doing, it's helping to reinforce this bearish trend. So that being said, I think it's hard to look at this as being put into a range trade situation. The yen, just like the Swiss, where other currencies were trading pretty much in correlation against or with the dollar. The US dollar yen has been trading lower for quite some time. And if the trend is your friend, then that means most likely what we've seen, especially with this rejection a week and a half ago of a lower move high, that the bears are here and they're here to stay, and they're going to look to press this market lower. So right now it's a little bit of a wide range trade here between 106.478 up to 108.501. Anything above, like I said, that 108.501 takes us off the bearish forecast for sure, and then you're looking at a obviously there must be, if that situation occurs, a very strong rally in the dollar index. So please key off that index as long as it's starting to show signs of weakness, and especially if it starts to show any severe turn that would reinforce a US dollar Japanese yen bear that would have this current little bounce where we're trading at just around 107.36 back down towards this 106.478 down into that bearish target zone. So remember, we've made a now already a lower move high and a lower move low. This is bearish, which fundamentally reinforces a slide in the US dollar yen. So we are looking for a potential turn in the dollar. We're starting to show signs of weakness. We are starting to see a bull potentially form in the euro with that buy signal from a week and a half that has seemed to held up. We'll see if the target range gets hit. We have the pound US dollar, which is looking like it is starting to gain some strength and some momentum. And then we had the US dollar Swiss, which already looks like it's rejected parity multiple times last week, showing a failure of US dollar strength. So perhaps the US dollar index really is going to get a turn, and in which, if that does occur, look for that to reinforce any US dollar Japanese bears, setting off a slide targeting that 106.478 level and down to the bearish target zone. And with that, just want to remind you to do your homework, look at the markets, always weigh the potential trades, have a plan, and stay the course. I'm Teddy Kekstadt from Forex Trading Unlocked. We appreciate your time today and the Nadex for sponsoring this webinar. You can always find me and more information about the FX markets at www.forex-trading-unlocked.com. And you can see us when we stream live webinars there on the homepage, or check us out on Twitch TV. And also, if you're interested in learning more about like that piercing line pattern and how to trade buy and sell patterns from candlestick pattern setups,
You can read my book, High Probable Japanese Candlestick Patterns. It's available on Amazon.com in paperback and Kindle version, and you can also read it if you're a Kindle Unlimited reader anytime. Just buy the page, whatever. You don't need to buy the book, although I would prefer if you buy the book. So anyhow, thank you very much for your time. You have a great day, and enjoy what's a little bit left of this summer.